Thousands of people believe buying a McDonald's franchise is purchasing a money printing machine. They're buying something very different. On paper, the formula looks almost effortless. You buy a store, people buy food, the brand brings the customers, the drive-through keeps the line moving, you keep what's left. And yet, the real economic question isn't how much does a McDonald's make? It's why two restaurants with the same arches can produce radically different outcomes for their owners, one quietly compounding cash, the other endlessly busy, while the bank account stays thin. Here's the catch. The visible business is burgers and fries, but the economic machine is throughput, contracts, capital structure, and a long list of costs that don't care how optimistic you feel on opening day. To understand where the money comes from, where it goes, and what determines success or failure, we have to follow a single store's cash through a system built to be standardized. Then watch what happens when the world outside that system starts moving. And we have to start with an uncomfortable truth. The most reliable details aren't in franchise blogs or motivational threads. They're buried in filings and disclosures you have to go look up. McDonald's is publicly traded on the NYSE under the ticker MCD. The official entry point for its financial disclosures is the SEC's EDGAR company filings page for McDonald's, CIKO000063908. And the company's own investor relations site is where annual reports and proxy statements are published. That raises the next question. What changes the economics from here? Those three doors, Edgar, investor relations, and the specific franchise disclosure document, determine whether you're doing economics or doing vibes. Because without the franchise disclosure document, the standard document that itemizes initial investment ranges, initial fees, and other required upfront expenditures for franchisees, a lot of the exact numbers people repeat are just not responsibly claimable from our source set. That limitation matters because it forces us into the real skill of ownership, not memorizing a mythical average profit number, but understanding the mechanisms that turn sales into cash and the mechanisms that turn cash into obligations. So let's build the business from the inside out the way a serious operator has to. At first, the business seems like a restaurant. In reality, owning a McDonald's franchise can mean operating a fast, high-throughput food factory that happens to have a dining room under a brand system that dictates standards, suppliers, technology, and workflows. That distinction changes everything because restaurants don't fail only from low demand. So where does the pressure move next? They fail from bottlenecks, points where the system cannot convert demand into served customers without costs exploding. A concrete picture helps. Imagine two rushes that look identical from the parking lot. Both are busy. But in one store, the line is a sign of controlled flow. Orders are accurate, the kitchen sequence is tight, and the drive-through time stays predictable. In the other, the line is a symptom of chaos. Orders back up, remakes spike, staff gets stressed, speed drops, and customers quietly decide not to come back tomorrow. The same sales today can create different sales next week. You own a conversion engine. You're buying the right to compete on execution. And if that makes you wonder what execution really buys you, what the simplest lever is, that question is exactly where this gets interesting. Because the simplest lever is not marketing. It's not even pricing. It's capital. The fantasy is that you buy a franchise the way you buy a small business. Hand over cash, get keys, start earning. The next question is what an owner still cannot see. But the capital reality is harsher. You are buying a position in a capital stack, and the stack has first claim on your future. Startup economics for a franchise usually hinge on initial franchise fees, build-out, equipment, real estate, and required working capital, numbers typically enumerated in the McDonald's FDD. Without that document in the supplied sources, we can't responsibly state exact startup cost figures here, but we can still trace the mechanism. Regardless of the exact dollar amounts, you're converting liquid capital into a specialized asset that can't easily be repurposed. The grills and signage are not just equipment. They're a bet that this location, this format, and the system will reliably produce enough cash to cover operating costs, fixed obligations, and debt service, with something left for you. A concrete example. A restaurant doesn't need to be unprofitable to break you. It only needs to be cash negative for long enough that payroll, inventory, and required payments start arriving faster than receipts. That raises the next question. What changes the economics from here? That's why professional operators obsess over working capital and volatility, not just average performance. They know the P&L is a story, the bank account is the verdict, and the owner mistake is predictable, treating the upfront check as the hard part and the operating cash cycle as a detail. So, what does financing do to this story? Financing is the amplifier. It can scale a good operation or accelerate a failure chain. When you borrow, you're not just paying interest. You're trading flexibility for growth. Debt turns a slow month into a countdown because the payment schedule doesn't negotiate with your weather, your staffing, or your construction detour. With little debt, you can survive by being decent. With heavy debt, you must be excellent, consistently. A concrete example looks boring until it's not. Equipment breaks, you replace it. Sales dip, you run smarter shifts. A manager quits, you cover. With the wrong leverage, those normal events stop being manageable friction and become existential. The owner implication is simple. If you don't know your fixed obligations, what must be paid even if sales fall, you don't know your risk. And if you're now wondering why a brand as famous as McDonald's doesn't guarantee safety, that's the next layer. The brand reduces certain risks, but it does not remove the physics of unit economics. So where does the pressure move next? Unit economics begins with the primary revenue engine, restaurant sales. At the store level, money comes in as transactions, customers buying food, across dine-in, takeout, drive-through, and delivery. That part is obvious. The less obvious part is what determines the size and reliability of that stream. Traffic, average check, and the store's ability to serve demand at speed without errors. That's where macro conditions sneak into the kitchen. BLS reports that food away from home prices rose 3.4% over the 12 months ended June 2026. It's tempting to hear that and think, higher prices, higher revenue, problem solved. The mechanism is more dangerous. A higher menu price can raise the average check, but it can also reduce traffic, change what people buy, and increase customer sensitivity to mistakes. When a meal feels expensive, a missing item stops being a minor annoyance and becomes the reason someone doesn't return. Right, Dave? A restaurant that raises prices and then slows down loses twice. Fewer customers and lower capacity utilization. The next question is what an owner still cannot see. A concrete example, at lunch you have a limited window where local workers choose convenience. If your line becomes unpredictable, they don't wait a little longer. They reroute their habit to somewhere with certainty. But the owner implication is that pricing power isn't a slogan. It's a trade-off. Your job is to protect perceived value while defending speed and accuracy. And if that makes you ask, okay, so where does the money go first? The answer is to the system and to the cost stack. Even without the missing FDD specifics, the structure is clear. Franchise economics are not just a store's profit, but a store's profit after paying for the rights, standards, and ongoing requirements of the system. At the corporate level, McDonald's revenue includes franchised revenue streams disclosed in SEC filings, which is why Edgar matters. The franchisor's model is documented there, while the franchisee's unit P&L is not automatically public. The consequence of that split is that the franchisee lives on what's left after paying their obligations, while the franchisor is designed to earn from the system's scale. A concrete example of how this feels on the ground. You can have a day where sales are strong, but after inventory, labor, occupancy, and all required payments, what remains is smaller than a casual observer would ever guess. And now the curiosity reset. If revenue is transactions times average check, what is the real production constraint that decides whether those transactions can even happen? It's labor, specifically labor organized into a repeatable operating rhythm. Restaurants are one of the few businesses where the product is made at the exact moment it's sold by people in front of the customer under time pressure. That creates a mechanism. Labor is not a single expense line, it is the operating system. Staffing levels and training quality decide speed, accuracy, cleanliness, safety, and ultimately repeat demand. The BLSOEWS program is a primary government source for occupational employment and wage statistics. That matters because you can't manage labor as if wages are a static input. You operate inside a local labor market, and that market can tighten or loosen regardless of your brand standards. A concrete example, understaff one position at the wrong time and the store doesn't run slightly worse. It changes the entire flow. The best cashier in the world can't fix a backed up kitchen, and the best kitchen can't fix a drive-through that can't move cars. That raises the next question. What changes the economics from here? The owner implication is that labor discipline is not being cheap with payroll. It's being smart with productivity. The aim is sales per labor hour, not payroll bragging rights. And if you're thinking, so the owner's job is basically scheduling? Close, but not quite. Scheduling is the visible tip. The real job is protecting reliability. Now look at the recurring cost stack that never stops. In restaurants, recurring costs typically include labor, food inputs, occupancy, utilities, maintenance, insurance, and tech systems. Each one has its own volatility and its own lag. BLS reports food prices rose 3.0% over the year, ended June 2026. That single number carries a mechanism. Even if your menu prices rise, your input costs can rise too, and not always in sync. The consequence is a squeeze that feels mysterious to amateurs. Sales can be up, but cash can be down. A concrete example, the store owner sees the daily sales report and feels relieved until the invoice cadence catches up and the bank balance tells the real story. The owner implication is that a good operator reads cost trends like a pilot reads weather, not to panic, but to adjust before the storm hits. So where does the pressure move next? And if that makes you wonder what other outside number matters to a burger store, it's the one you see on a sign you'd never associate with French fries. EIA reports a U.S. regular gasoline retail price of $4.48 per gallon, May 2026. The mechanism isn't that your restaurant buys gasoline directly in huge quantities. The mechanism is that fuel prices ripple through distribution and delivery economics, and they also shape customer behavior at the margin. When travel feels expensive, some trips get combined, delayed, or skipped. A concrete example, delivery becomes more expensive to fulfill across the ecosystem, and customers become more selective about add-on purchases. Your store doesn't need a dramatic collapse. It only needs a small decline in the wrong day parts to miss its fixed obligations. It's to accept that the unit's economics are exposed to macro volatility, even when the brand is strong. So where do underestimated costs hide? They hide in the gap between operating and owning. Maintenance is the obvious one. Equipment wears out. But the underestimated category is compliance with brand standards and technology requirements, because those costs often arrive as mandatory upgrades, not optional improvements. The National Restaurant Association highlights research on the restaurant technology landscape and economic indicators. The mechanism here is that the modern restaurant is partly a software business, ordering channels, payment systems, staffing tools, inventory management, and delivery integrations. Technology can raise throughput and reduce errors, but it can also create new fixed costs, new training requirements, and new points of failure. A concrete example, a system outage or confusing interface increases order errors. Errors create remakes. Remakes slow the line. The line creates customer frustration. Frustration reduces repeat visits. Suddenly, a tech issue becomes a revenue issue. You change the way the restaurant works. That requires leadership and process, not just equipment. Now we can name the binding operational bottleneck that decides whether all of these costs are survivable, throughput under constraints. The next question is what an owner still cannot see. A McDonald's store is designed to win on volume and consistency. That's the promise. In practice, the hidden constraint is that volume only turns into profit when the store can produce meals fast enough to keep customers from abandoning the line while keeping labor and waste under control. A concrete example, if your drive-through time creeps up, the tail of the line spills into the street. Some drivers decide it's not worth it and leave. Your sales don't just flatten, they become more volatile because you're losing the easy repeat customers who built the baseline. It's the main valve controlling revenue, labor productivity, and customer loyalty. And now we're ready for the failure chain, the way one setback becomes a cascade. It usually starts with a shock that looks manageable. Costs rise, staffing gets harder, or demand softens. BLS reports CPIU increased 3.5% from June 2025 to June 2026. The mechanism is that broad inflation pressures both sides of the ledger. Customers feel squeezed, and operators face higher costs. That raises the next question. What changes the economics from here? Even if your store isn't hit evenly, your customers and your labor pool are. When customers are more price sensitive, promotions matter more. When workers have more options, retention becomes harder. A concrete example of the cascade: a manager quits, training slips, speed drops, refunds rise and reviews worsen, and hiring gets harder because the workplace feels chaotic. Meanwhile, fixed obligations keep ticking. The owner, trying to protect cash, cuts labor hours. That makes service slower. That loses more customers. The store gets busier in the worst way. Busy fixing mistakes. The owner implication is blunt. In a high-throughput restaurant, cutting into execution to save money can be the most expensive decision you make. So how do you prevent that chain? That leads to economies of scale, because the franchise dream often becomes own multiple stores. Scale can improve your economics, but only if it improves your control. With more units, you can sometimes spread management talent, negotiate better local hiring pipelines, build internal training, and create coverage so a single resignation doesn't cripple a store. The mechanism is managerial bandwidth. Multi-unit ownership turns into a system of systems, where your real product is leadership and process replication. Multiple stores amplify not just profits, but problems, culture, turnover, maintenance backlog, and inconsistent execution. A concrete example: a single store can survive with an owner who personally patches holes. A portfolio cannot. The moment the owner becomes the bottleneck, standards degrade across all locations. The owner implication is that more stores is not diversification if all stores share the same weak operating system. And if you're wondering what separates a professional operator from an amateur owner, it's not how much they love the brand, it's what they measure and what they refuse to compromise. So where does the pressure move next? The amateur assumption is that the brand will carry them. The professional operator treats the brand as a platform and treats operations as the investment thesis. They obsess over reliability at peak times. They train for speed and accuracy like it's manufacturing. They anticipate cost volatility instead of hoping it stays calm. They build management depth so the store doesn't collapse when one person leaves. And they understand the difference between being busy and being profitable. Busy can be a symptom. Profitable is a result. The consequence of professional behavior is compounding. Lower turnover reduces training costs. Better training improves speed. Speed improves customer satisfaction. Satisfaction stabilizes traffic. Stabilized traffic makes scheduling easier, and scheduling discipline protects margin. Not slow shifts, boring ones. The kind where the line moves, the store stays clean, the team knows the drill, and problems get solved before customers notice. The owner implication is that you're not buying a restaurant. You're buying a daily management challenge packaged as a brand. The next question is what an owner still cannot see. Now zoom out to the future, markets, technology, and regulation, and why the next few years may feel different than the last few. Inflation doesn't have to be extreme to be destabilizing. Even when headline pressure cools, the sequence of changes can permanently reset costs and customer expectations. BLS notes that between December 2023 and December 2024, consumer prices experienced disinflation. The mechanism is psychological and operational. Disinflation means prices still rise, but by a smaller amount than before. Customers may feel like relief should arrive, while operators still face elevated cost bases and the need to keep wages and prices aligned with a new normal. The consequence is a trust gap. Customers become skeptical of price increases, and staff become skeptical of wage stagnation. That gap shows up as traffic volatility and retention challenges. A concrete example. A store tries to protect margin by raising prices, but customers compare it to their memory of last year, not to your invoices. If you can't justify the value through speed, accuracy, and experience, you lose. That raises the next question. What changes the economics from here? The owner implication is that the future favors operators who can deliver value operationally, not just discount value on the menu board. Technology will keep pushing into ordering, payment, kitchen workflow, and staffing. That can raise capacity, but it also raises the penalty for being behind. Meanwhile, energy prices will remain a moving context variable. EIA provides weekly and periodic retail gasoline and diesel price data. That cadence matters because it tells you this is not a set it and forget it environment. Now, the nuanced verdict, who may succeed, who is likely to fail, and the decisive economic insight. The operator who may succeed is not the one who dreams about passive income from a famous logo. It's the one who can turn standardization into advantage, who embraces systems, builds management depth, and treats throughput like the core asset. They respect the capital stack. They plan for volatility. They don't confuse sales with cash flow. So where does the pressure move next? The owner likely to fail is the one who buys the fantasy. The idea that a brand eliminates the need for operational excellence. They underestimate recurring obligations, overestimate the stability of demand, and assume labor will work itself out. They leverage too aggressively, then discover that a restaurant's problems arrive on a schedule, usually during peak hours. And the decisive economic insight is this. A McDonald's franchise isn't a simple business because it sells simple food. It's a high-throughput production system wrapped in a brand, financed with fixed obligations, operating inside macro forces you don't control. You don't win by having customers. You win by converting customer intent into accurate meals fast, day after day, while managing a cost stack that moves with the economy. The arches attract attention. That changes when economics rewards reliability. The next question is what an owner still cannot see. And if you want to know where the money really is, don't start by asking, how much does a store make? Start by asking, what breaks first when the world changes? And do I have the operating system to keep serving anyway?